Section 4.1 Introduction to Beta, Limitations and Considerations. 4.1 Limitations of Beta. While beta is a widely used risk measure, it has several limitations that investors should be aware of when using it to assess investment risk. Here are some key limitations of beta. Reliance on historical data. Beta is calculated based on historical price or return data. As a result, it may not accurately reflect future risk and return dynamics. Market conditions, economic factors, and company-specific events can change over time, rendering historical beta less relevant for future predictions. Lack of consideration for non-systematic risk. Beta only captures an investment's systematic risk, which is its sensitivity to market movements. It does not account for non-systematic or idiosyncratic risk, which is specific to a particular company or industry. Non-systematic risk can include factors such as management decisions, competitive landscape, regulatory changes, and other company-specific events. Beta alone may not fully capture the total risk of an investment. Homogeneity assumption. Beta assumes that all investments within a particular asset class or category have similar risk characteristics. However, this assumption may not hold true in practice. Different companies within the same industry or sector may have varying risk profiles due to factors such as financial health, competitive advantages, or management quality. Beta does not differentiate between these variations, potentially oversimplifying risk assessment. Sensitivity to benchmark selection. The choice of benchmark index can impact beta calculations and, consequently, the interpretation of risk. Different benchmarks may have different compositions, weighting methodologies, or sector exposures, leading to variations in beta values. Investors should carefully consider the appropriateness of the chosen benchmark when analyzing beta. Shortcomings in volatile or illiquid markets. Beta calculations rely on the availability of consistent and reliable price or return data. In volatile or illiquid markets, where prices may be sporadic or subject to manipulation, beta estimates can be less accurate. Additionally, low trading volumes or market inefficiencies can distort beta calculations and undermine their reliability. Limited for diversification assessment. Beta provides a measure of an investment's sensitivity to overall market movements but does not capture its correlation with other assets or the potential diversification benefits. Two investments may have similar beta values, but their correlations with other assets may differ significantly. Therefore, beta alone may not provide a complete picture of diversification benefits. Beta may not account for tail risks. Beta primarily focuses on the relationship between an investment and the overall market. It may not adequately capture extreme events or tail risks, which can have a substantial impact on investment performance. Investments with low betas may still be vulnerable to rare or unforeseen events that can cause significant losses. Despite these limitations, beta can still serve as a useful tool when used in conjunction with other risk measures and analysis techniques. It provides a quantitative measure of systematic risk and helps investors assess the relationship between an investment's returns and market movements. However, it should not be relied upon as the sole determinant of investment decisions, and investors should consider a broader range of factors and risk measures when evaluating investments. Outliers and extreme market conditions can have a significant impact on beta calculations, potentially affecting the reliability and interpretation of beta as a risk measure. Here's how outliers and extreme market conditions can influence beta calculations. Distorted beta estimates. Outliers, which are extreme values that deviate significantly from the norm, can skew the calculation of beta. If a few data points have abnormally large returns or exhibit extreme volatility, they can disproportionately influence the beta calculation. This can lead to inaccurate estimates of an investment's sensitivity to market movements. Increased volatility during extreme market conditions. During periods of extreme market conditions, such as financial crises or sudden market shocks, volatility tends to increase substantially. High levels of volatility can impact beta calculations as the historical data used to estimate beta may not adequately capture the extreme price movements experienced during such periods. Beta estimates based on volatile data may not accurately reflect the investment's risk characteristics during normal market conditions. Nonlinearity and changing relationships. Outliers and extreme market conditions can disrupt the linear relationship between an investment's returns and the returns of the market index. Beta assumes a constant relationship between an investment and the market, but extreme events can introduce nonlinearities and changes in the correlation structure. As a result, beta estimates may not capture the true risk profile of an investment during periods of market stress or unusual market behavior. Longer-term impacts. Extreme market conditions can have longer-term impacts on beta calculations. For example, a significant market downturn followed by a prolonged recovery period can distort beta estimates, particularly if the recovery is characterized by different market dynamics. In such cases, using a longer time period or incorporating more recent data may be necessary to better reflect the investment's risk profile. Sensitivity to data frequency. The frequency of data used for beta calculations can influence the impact of outliers and extreme market conditions. Higher frequency data may capture short-term market movements and outlier events more accurately, whereas lower frequency data may smooth out these extreme observations. The choice of data frequency should be considered when assessing the impact of outliers and extreme market conditions on beta calculations. It's important to exercise caution when interpreting beta values during periods of outliers and extreme market conditions. Investors should be aware of the potential distortions introduced by such events and consider using additional risk measures, conducting scenario analyses, or applying robust statistical techniques to better capture and evaluate the risk associated with investments. Additionally, regular monitoring and updating of beta estimates based on the latest data can help mitigate the influence of outliers and extreme market conditions on beta calculations.